Hi, everyone. Welcome to Zillow Rentals Quarterly Insights webinar for Q1 of 2024. I'm Brian Miller, Director of Partner Experience and Engagement, and I have the honor of serving as your host for today's program. These webinars are designed to provide you with the latest trends, market analysis, and predictions to help inform your business decisions. Whether you're a property marketer, owner, or simply just interested in renters and the rental market, this webinar is packed with information that will empower you and help you stay ahead of the curve. This quarter, we're thrilled to again host our resident expert and the woman who makes the data make sense, Zillow's chief economist, Dr. Skylar Olsen. Skylar was a foundational member of the Zillow Economic Research Department, where she leads a team of economists and analysts who provide unbiased data about the housing market to inform policymakers, journalists, academics, and consumers. She is often quoted in media outlets around the country, and we are so fortunate to have Skylar here to unlock economic data for our partners. Welcome, Skylar.
Hey, Brian. Thank you so much for having me. Always a pleasure.
Well, we're going to try something a little new this quarter. We received a list of questions from some of you that you sent in when you registered. And today we're going to organize our program around answering some of those questions. So a big thank you to everyone who submitted. If you have more questions during today's webinar, go ahead and throw them into the chat, and we might answer them next time around. Skylar, are you ready?
I'm ready to go. You betcha.
All right. Well, question number one, with the 50-year highs in multifamily new construction, it feels like we might have more rental supply than demand. What impact do you see this having on rent pricing? And do you see any population shifts in the future that might change this equation?
Brian, this is a great question, and one I was not surprised to get. I think this is top of mind for a lot of people that work in the rental market across the US. And it's true, we are at record high levels of construction. So inspired by this question, I really, as Brian kind of mentioned, my whole shtick is turning on the light about data. So we're going to start first with the census data that lets us know just how much we are producing right now, how many apartments, and I'll even show you the single family building pipeline too. And then we'll get to the impact on rent, because it absolutely is having an impact, and we can explore that with Zillow data. So to start with the census data that we do see, this pink guy is what's giving, I think, a lot of rental market professionals that are working on the supply side pause, right? Because what we're anticipating here, what you're thinking about, is all the new competition that's coming online and enticing potentially your renters away. Now, we've got these units under construction, and purple is at record highs, but we really didn't start to see rent go soft until that blue guy popped up significantly above where that dotted line is. So what are we looking at? The blue guy, that's the actual multifamily or apartment units that were completed. As you can tell, the purple, the number of units that were under construction, started elevating much earlier on over the course of the pandemic. But the units completed weren't really kind of significantly above normal or above pre-pandemic until this past year. Now, I want to show you the single family side of the picture, because it has the potential to be a larger share of the rental market. And here what we're looking at is a similar but really different story. One, notice the start of the line. In the last graph that I showed, multifamily apartment construction is far above where we have seen it in decades. If I think about single family construction, we're actually not building as much as it might feel like there was a bit of a boom here over the course of the pandemic, and we can see it in that light purple line here. If I look back in the past, the housing bubble of the 2000s was actually much bigger when it came to building single family homes. Well, so check it out. The number of units that were completed were elevated really at the start of the pandemic, because it's easier to produce single family homes than it is to produce large apartment buildings. You can also see that after mortgage rates kind of swung up, The units under construction started to moderate, and now you can see this at the end. Notice that it's stabilized, right? Or it looks like it's starting to stabilize. Now, one of the things that we're thinking a lot about is like, why is that stabilizing? Is you've got new single family units that are permitted, right? Has recovered to that pre-pandemic pace. So that's that gold line right there. Now, multifamily construction in terms of permitting is at least slowing down. So if we think about that first line, that's why that's stabilizing on that side as well too. We don't see as many new permits, and that's because the market is responding. What does the market respond to? Well, all the new construction that we saw in apartment construction and in some ways single family construction, though that has a lot to do with for sale home price appreciation as well, has to do with the signal that we all see, which is that rent is growing. When rent grows, it's showing us that demand is overwhelming supply. And on net, over the course of the pandemic, that's what we experienced. So what we're looking at here is a map of how, rent has grown, asking rate rent has grown since the start of the pandemic. You can see sensational rent increases in the Mountain West and Southwest of the United States, as well as the incredible rent growth of Miami and a lot of other Florida markets. We've seen much more modest rent growth over the course of the pandemic in the Northeast. And Texas, in so many ways, has moderated, I think, because of a lot of the supply that pulls forward. Now, in terms of where we built a lot in those previous graphs, there's a lot of new construction going on in Texas, but there's a lot of new construction going on in Florida as well. But it's important to remember, when we think of a place like, say, Florida, right, not all of the new units that are being produced are also often replacing units, that are less viable over time in a state that's changing very rapidly. Now, before I move on, just check it out. San Francisco, rent growth has been much more flat over the course of the pandemic. That is a metro that has struggled. And Minneapolis is a similar kind of situation where, previously strong population growth before the pandemic moderated over the course of the pandemic, and rent growth has been much more slow. Now, you said, or Brian, you teed this off with like, hey, we're anxious about that element. But what do we see that might, what are the population trends that maybe might turn this around, right? I've shown this graph a lot before. When we look at this age distribution of the US, what we'll notice, right, in that bright green is that the millennial generation is really large relative to, say, Gen Xers. And at this point, much bigger than boomers, right? We of the millennial generation are certainly here, and we're a large population. Now, how old we are is kind of bearing down on rental markets right now, in the sense that you've got the median age of moving out from your parents is now 26, and the median age of a first-time homebuyer is 36. So the hill of millennials is right there. But let me show you how I might interpret how this kind of population changes over time. So this hill ages, right? This big generation gets older and moves, more and more into these moving age groups. Check out the left side. This is the population that's 25 to 44 years old. These are prime movers. Later, I'm going to talk a little bit about how it's harder to move onto the for sale market. So renters are getting older. So I felt at liberty to kind of pull it up into the low 40s here. Now, the population in this prime mover age group is increasing and will continue to increase for many years ahead. But what has happened over the course of the pandemic, and one of the other reasons why we are pretty sure we have enough population to absorb this growth, right, is that we're actually peaking and just at this moment on how fast that population is growing as they age into it, right? So we're at this height of kind of demand pressure, which is why we saw so much building. Now, we're going to look at rents in a second to see how those have netted out and where the current rent growth has slowed down. But before I even move off of this idea about population growth, I just want to address another common question I hear about, which is low birth rates and whether or not that'll affect US housing markets. We still accept so many people from outside the US. And the Congressional Budget Office actually just re-released their estimates for immigration and how much that will contribute to population growth in the future. And we've seen an incredible uplift over the past year in terms of, not worrying, in other words, about the lower birth rate. You see how that those ages at the beginning of that age distribution, there's fewer of them, right? Fewer kids being born within the US every year, but we are inheriting a lot of prime mover age population from elsewhere. Now, the other good news, in terms of the population is how able is that population to afford rents? In other words, how is their job prospects? How is their financial security? We're worried about recessions, or we have been worried about recession, because inflation became a big problem and the Fed started to put upward, or rather contractionary pressure on the economy in order to bring these measures down. These are common measures of inflation that I'm not going to, general inflation that I'm not going to go into too deeply, but just check out and see how that's getting better. And it's getting better because the Fed has been putting downward pressure, on the economy. But what you should notice here is that unemployment rates remain fairly low. They are not expected to increase very much. And though the economic activity is slowing down, on the right, you see monthly change in employment growth. It's not going negative, right? And it's even kind of stabilizing forward. In other words, economists really aren't expecting too much of a recession. So we're seeing a lot of strong population growth in the United States in prime buying, moving age groups, and that population is more likely at least to be financially secure into the future than maybe we previously had thought when we were worried more about recessions. Okay, so all of that nets together, the supply and the demand side. And what are we seeing? It is true that rent growth is slower. Here we're looking at Zillow's observed rent index. We built this metric using the rental listings that we see on Zillow's site. We're able to produce this index by looking at units that change in their asking rent over time. And so here we've created a rental index that tracks how asking rate rent has changed across the whole US. So here you see in black, you can see how quickly it grew and then how it's flattened out. The year over year shows us that at one point we maxed out at 16% annual rent growth nationally, which is incredible. That has since slowed down, if you can track your eyes back, to a pace that's very similar to pre-pandemic. Now, if I look at that rent growth, deseasonalize it, now you're looking at month over month change. You can see that element, how we're growing very similarly to where we were pre-pandemic. So not radical rent falling. In this measure where we're combining property types, I'll show you later that multifamily or apartment rents are actually falling month over month negative right now. But when we're on net across the full rental stock, you can see that it's a little bit balanced out. Now, let me put the seasonality back in, because we are currently ramping up. If you think about the position we're in right now, we're taping at the very, very end of February. You will probably be watching in March and potentially into April. That will be one of the strongest times in the rental market. This is absolutely the time to get your eyeballs in front of potential renters. There'll be the biggest swelling of demand over supply, as seen by the seasonality in Zillow's observed rent index, usually swelling around April. You can see pre-pandemic. Seasonality post-pandemic has been a little bit off. We come a bit later, so you have a little bit more time maybe than you used to, but better to be ready. Now, you can see that January is a bit softer here relative to maybe pre-pandemic when we don't do those seasonalized. Just the pointing out, Januaries have been challenging over the course of the pandemic. So that January that you see there is a faster rent growth pace than previous Januaries over the course of the pandemic as well. Back to this kind of more normal growth. Now, that was a national picture. Things are really different when we start looking at local markets. Here we're seeing metropolitan rent growth across the country. You can see that strong, or more consistently strong, increases to annual asking rate rent in the Midwest, where these markets are more affordable. You can see rent falling in Austin and particularly soft in, say, Dallas and Atlanta. Let me move forward into current month-over-month changes because you can see it continue to soften even more. In, say, Dallas, it gets even paler. San Antonio falls in line as well in terms of softer rent growth. Buffalo is seeing softer rent growth as well as Boise. When we look at those month-over-month changes, right? You can look at the heat in the Northeast. Seattle returns to a bit more rent growth, as well as Sacramento and Chicago. Now, all of this change over the course of the pandemic has moved markets, right? I want to point out, we talked in the beginning of this, San Francisco has, struggled kind of a lot over the course of the pandemic. Boston is now a more expensive housing market than San Francisco. With that continued rent growth, San Diego has surpassed Los Angeles, right? And good golly, Miami is most certainly the new New York. Would you believe actually 6% of the people searching from the New York Metro are looking down in Miami? Now, that's a lot of change, Brian, and I know I took a lot of time with that one question that you asked, but it's an important one. And rent really lets us see kind of this balance between supply and demand. As we move forward, we certainly don't expect too much change, actually, to the current pace that we're watching because of that elevated construction and because of elevated demand. We're expecting asking rate rent to kind of maintain its current course.
Well, thanks for those insights. If we could dial in a little bit with question 2, what impact are we seeing on Class B and C properties from this boom in construction?
Yeah, this is a great question because I think what it's really trying to address, right, is this idea that, rent growth is probably changing very differently, or that pressure on rent, the relative balance between supply and demand is going to be different at different areas within the metropolitan space, right? So not just different for this metro versus another, right? To watch Austin get much softer than, say, Hartford, Connecticut, which is still rent growth looks very strong, right? Now we want to think a little bit more about the different properties across a metro. Now, if someone says to me, Class B and C properties, what it generally means is older properties downtown or further out in space. Now, here's where we have to get creative with what rental market data we have available. So Zillow cuts our Zillow's observed rent index by a few different layers. Okay, we're going to start first with something I mentioned at the beginning, this idea that we saw a lot of new deliveries in multifamily apartments to the metropolitan area. And while we did see an uplift in single family construction over the course of the pandemic, relative to history, the apartment building was sensational. Okay, so if I look at this graph, what I'm going to most certainly notice is that the multifamily asking rate rent is moving more slowly, right? And if I tie that intuition together to what we just talked about, seeing all that new supply take place, you might also imagine that higher end multifamily buildings, those that are more likely to compete with the new product, would be appreciating more slowly still. So let's say you're asking me about those B and C, product out there. If they're in an area where there's not a lot of new construction, say further out from the core, they could still be increasing in rent as well. Also, if it's in a historic area where it's harder to build new apartment product, that could also maintain that pressure because remember, demand is still strong. So if you have particularly unique offerings, right? Demand out there is present. So you can continue to see that pressure, much like we continue to see rent growth pressure in single family neighborhoods, say, where we haven't seen the same uplift in supply. Now let's tackle the idea of maybe not, the prime buildings downtown or in the urban cores or, the hip spaces. Now let's think it in terms of maybe further out into secondary cities or suburbs and that kind of product. I'm showing you here, I've taken 3 examples to kind of walk us through. Here we're starting with Denver because, well, there's been a lot of fascinating markets to study, but this one's a good example where I think a lot kind of bounces out at us. Excuse me. So Denver's a market where a lot kind of bounces out of us that we can see things that are going on. If we look at asking rent growth, right, in early pandemic, right, we can see that extreme kind of rent growth, more reds are popping out at us, particularly in West Denver metropolitan area, right? That incredible rent growth. Then in 2023, remember, that's when we started to see the deliveries. So on net, you can start seeing Denver get very cold. But let's look into 2024, and you can see that this is a market where now that rent growth has started to return in a lot of those same areas that had been cool. In other words, you're starting to see demand catch up to, I think, some of the delivery or some of the space here. That doesn't mean all areas of Denver are turning around. Some are continuing to cool off. You can see as you move into Boulder, right? That's more of the story of continual rent falling, but that was also a very hot market over 2022. Let's move on to the next example in Atlanta. You see that first incredible rent growth, lots of reds pop out at us on the left here in 2021, that extreme rent growth. Then we can see things start to kind of balance out. Core Atlanta gets cold, rents falling in 2023 a lot. That's when we really started to see the completes start to come online. But I want to point out that even in 2023, you're still seeing a lot of strong rent growth there in southern Atlanta, much more suburban, generally more affordable area of the metropolitan area. Same thing in 2024, that maintained pressure, and actually some spots that were cool in 2023 have kind of since come around. You see certain cities with that rent growth returning. That said, here we've got still spots of cool rent growth in 2024, some that even cooled off from the previous year, continue to cool off. What I'm trying to show you is or the progression we're making is Denver had more cities that kind of turned around again, rebalancing, continuing, returning that popularity above and beyond the new supply. Atlanta was a bit more of a mixed bag. Dallas is a spot where we really were producing a lot more product, both in the multifamily and single family space. And here you can see it almost continue to get more blue as we move into this year. So Dallas, I think, we are primed to continue to keep softening. So it really very much so depends locally on where that new product is, but it is completely possible with the strength that we talked about earlier of demand and avoiding, knock on wood, but avoiding the recession affecting that soft landing. Rent should be able to turn around again. There are certainly enough people that want to live in many of our prime metropolitan areas, and in particular, in the B and C space, sometimes if it's around in an area kind of further on, generally for that aging renter kind of space and demographic.
Well, with all of that in mind, when we need that extra push, it's a good time to ask question number 3. Which is, what trends are you seeing in renter concessions? Do conditions point to continued financial incentives, or might we see increases in other options like lease flexibility or conveniences like parking?
Yeah, I think from the perspective of thinking about what might change or what might the shape of concessions take on is certainly a good one to think about, because there are a lot of buildings that do have new competition. There are certainly enough renters, but if they have choices at one time that are very similar, right, you're still going to be in a fairly competitive space. Now, I'm showing you 3 examples here that I plucked because they had very different rent trends, right? Salt Lake City rent was very soft. And here I see the share of rental listings on Zillow that are offering concessions increase very quickly. Though the last month it did come down. You see at the United, like national level, around a third of our rental listings on Zillow are offering a concession. The ones that we are tracking is generally months free, waiving fees. And then you see someplace like Miami, Florida, where rent, as we saw kind of in the beginning, has been strong over the course of the pandemic, continues to be fairly strong. And really, we have not seen the kind of rental concession offers. Now, if you think about the trend here, though, on all of them, is that they are lifting, right? This idea that we're seeing kind of more rental concessions as we are no longer seeing asking rate rent growth. There may be enough demand to keep asking rate rents from falling, but it is still worthwhile to pursue different alternatives to attract the renter to your specific properties. Before last month, we saw, as you can tell, rental concessions look to be on a consistent kind of increasing trend. Last month, our January numbers, and we're waiting for February numbers, just another 2 weeks until those become public. I get to see them next week. But 2 weeks until they become public to see whether or not we'll continue to see that hook at the end where the rental concession decreases. Once we start to see that kind of thing, I think you can, as you phrased, Brian, in this question, instead of maybe seeing multiple months free, right, there are other options that might entice the renter that might not make too much of a hit on the balance sheet. Now here, just to be able to show way more markets than just the 2 time series that I added to the national one in the beginning, you see the share of concessions the share of rental listings on Zillow with concessions in many of the major metropolitan areas. Pay attention to the color. If it is red, this is an area where the share of concessions is falling. I don't know if you remember, but if we looked at that month-over-month growth on asking rate rent, the Northeast looked pretty hot. By the way, that's an area where for sale new listings have pulled back significantly over the year. So there's a lot of folks moving to those areas. And there's just not a lot of options, even if we are producing a lot more on the apartment space.
Perhaps it is related. Question number 4 asks, I saw that Zillow released a room for rent listing type. Does that suggest there is a need for more of this type of inventory?
Absolutely. I'm actually really excited about this kind of product for the renter because of a lot of the renter challenges. Let's take those Zillow's Observed Rent Index or our the median rent or the typical asking rate rent that we see on Zillow in our analysis from Zillow Economic Research. But let's recast that, right? Let's say, what would be that income that you would have so that you would only be spending around a third of your income on that asking rate rent that we've measured here? And turns out over the course of the pandemic, so these 4 years, you would need to make $18,000 more than you did pre-pandemic to afford kind of the same style unit, say, if you were for asking rate rent. So in other words, to a new mover. We've also done, by the way, other analysis that shows if you stick with your landlord, right, you consistently can get a bit of a rent break over time, right? Because as rental property managers know, right, you don't, there's no vacancy on the part of the landlord, right? And it's kind of a win-win situation. So generally off-market rent growth is much lighter. But let's say you were paying market rate rent before the pandemic and you've recently moved. You need on average 18,000 more. What you can see across this map, right, is that the affordability of housing across the US varies a lot, right? Now, this isn't true affordability. This is just how I cast the rents forward, right? Now, it turns out if I'm in Miami, where I would need $108,000 a year in order to afford, the rents in that major metropolitan area, Turns out you also probably make a little bit more in Miami too. Actually, Miami is one of the places we'll see in a second where affordability is still a big challenge. But other areas that we have these high level numbers, like New York, generally the earnings are much higher, right? San Diego, you make more. So let's see what that nets out to. Notice that the colors have kind of changed. Now I have a little bit more consistency across these regions. What have I done? I've just taken the rent and now divided by the actual income, right, that people earn in that local metropolitan area. You can see how Miami kind of started to look even worse, right, in terms of the so high rents, and then incomes aren't quite as high to meet them. And you can see that challenge in Los Angeles, right? You can see the challenge in New York. You can see the challenge in Boston, Sacramento, Las Vegas, right? These are Sacramento and Las Vegas, by the way, are big kind of changes over the course of the pandemic, that they became radically much more unaffordable. And then you see kind of in the Midwest, right, maintains that affordability. Now, I've labeled this slide like, this is a reason to move. So let's say I was, trying to live my best life in a really expensive Los Angeles metro. I could probably achieve more out of my life, live in a bigger space, live more independently if I was to move to a different metropolitan area. But the reality is that a lot of us are very local to where we live. I'm going to move back to that previous slide, but here's some search data that I wanted to show you. 68% of the searches where people are searching for Cleveland area homes, right, come from Cleveland, right? So you search where you are, and that's, kind of where you expect to stay. That's most of us, okay? Now, if you look at where else they're searching from, they're not looking from too far. Akron, Columbus, right? So they're seeking usually to stay. Now, the previous point I was making is you've got folks looking in Cleveland from Los Angeles, right? From Miami, from San Francisco, and that's, the affordability that this metropolitan area might offer, right? But for the most part, you're seeking local. So what do? You often will double up. The room for rent offers that incredible or better access to affordability for the renter that needs it, right? Now, the share of movers who moved between states because of the affordability challenge, look over the last more than a decade here, right? The share of movers, so of all movers, what share moved between states when they moved? See how over the last 15, almost 20 years, 20 years, wow, time flies, huh? Almost 20 years, you've seen that trend kind of increase, where more folks are moving farther, I think, because of that affordability challenge. But at the same token, check out that purple guy. A smaller share of the total population is actually moving each year. That actually has a lot to do with the fact that we are getting older, but it also has the fact to do that when it's an affordable challenge, it is a harder thing to pull off. Now, before I move too far over, I wanted to give the Providence, Rhode Island example. Providence, Rhode Island is near New York, right? New York falls kind of highest in the number of searches after that, but check out Boston, right? Boston was that super, also very expensive, right by Providence. The relative affordability is a big draw, but it's also a huge strategy that people have to double up. Now, one last thing. Let's say, what are the advantages that someone has for the room for rent? It's not just affordability in this moment. It's affordability in this moment to achieve the next thing, right? We still see high sentiment for home buying. The problem is that for much as I talked about rent affordability as a challenge, to move on and become a homeowner is incredibly challenging right now. Here you're looking at that same affordability measure, like what share out of median household income would it take to afford my monthly payments? But now this is for sale monthly payments. So property taxes and insurance, but most importantly, that mortgage payment. And with high mortgage rates, it can take up a huge share, and you can see how much it came up. Now, in order to afford to become a homeowner, now saving for a down payment that's even larger is more important. So see how much more affordable it became to have 20% down instead of 10. But home prices have outpaced incomes as well. If I can better afford my rent, I can better save for the future. this is a good product for, honestly, flexibility for all the options that we want to offer very diverse renters across the full marketplace, but also for their diverse options that they'll have down the road. It provides greater flexibility, greater financial resilience. There are a lot of questions I am often asked, and Brian, I'm really excited for this opportunity to share with our community, your community of rental market professionals that are trying to navigate this space. So thanks for the opportunity.
Well, thank you, Skylar, and thank you everyone for submitting those questions. I hope you've all enjoyed this quarter's webinar. Remember, we've got a lot more information that you can find on Zillow.com/research and Zillow.com/data. So make sure to take a look and make sure you stay tuned for our next quarterly Insights webinar. Thanks again, and we'll see you soon.